The going concern assumption is a fundamental accounting principle. In essence, it challenges the very existence of a company, not as of today, but its ability to survive till tomorrow. On the assumption that there is no change in any regulation affecting the company, the directors are responsible to assess the company's ability to continue in business in the coming 12 months. They consider the company's potential in terms of demand for its products or services and its profitability. Unless management intends to liquidate the company or to cease trading, the directors shall prepare the financial statements on the going concern assumption. The auditor assesses primarily the work and conclusions of management before reverting to other tests to confirm or otherwise the director's conclusion. His conclusion is included in the audit report, with reference made to the note disclosed in the financial statements by management. The auditor's assessment of going concern starts at the planning stage and continues throughout the audit. Audit testing therefore do not stop with the figures. The variances in figures is just a window to the whole picture. The auditor focuses on particular matters like the company's ability to renew any agreement nearing its expiration date, employee turnover, current court cases, and the company's ability to meet any obligations that may arise from any loss cases. Auditors also test the extent of competition in the market and the company's plans to mitigate fierce competition and possible new sources of income. Assessing going concern need to be taken case by case basis, as there may be authorities imposing certain requirements that not meeting them may affect the company's ability to continue its operations. The auditor's tests and considerations may send the directors back to the drawing board to reassess their conclusion re going concern. The aftermath of this affects the type of report the auditor will issue in relation to his opinion on the going concern assumption of the company. If the auditor's results do not agree with management conclusions, they may agree to revise their original assessment. If it is in agreement with auditor consideration, even if there is a material uncertainty, the audit report will be modified but not qualified. Included in the auditor's opinion, a reference is done to the note in the financial statements indicating the event giving rise to the material uncertainty and the mitigating factors management has in store. However, if management are not willing to make further tests and reassess their conclusions, the auditor may qualify the report and includes an explanation of the basis of the qualification. The going concern assessment indicates the management commitment to the company's continuity and growth. Indications to this are also evident within the financial statements that can be observed even by non-financial oriented users of accounts. By familiarizing oneself with a set of accounts, these users can also come to their own conclusion whether the director's conclusion on going concern is appropriate. Such indicators include: is capital expenditure split over a number of years, what in accounting we refer to as depreciation? Are borrowings divided between short and long term? Is the accruals basis being used? That is, does the income statement shows only income and expenses relevant for the year being reported? Does the company present its financial statements using historical cost method? Users need to take note of these underlying messages, as a decision to invest or not depends on the user's assessment of the company's potential to generate profits. So I encourage you that next time you are analyzing a set of financial statements, look for these indications and assess the company's going concern assumption taken by the directors, so that your decision is taken on a well-calculated risk.